Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading report for February 23rd, 2018. We'll follow this script as we go through the weekend reports and record the symbols that we will be framing as part of the advanced swing course. Market is in bullish volatile conditions on an annual basis using weekly RSI 14, and the higher end of neutral at 60 out of 100. The 10-day NDX, we are deeply overbought at 97 out of 100. We'll use that to ensure that we've locked in profits from that nice swing. Since the price has already rebounded nicely. Price relative to the 200-day moving average is 7.62 or white bullish. The slope of the 50 is improved to yellow neutral 0.26. ADX is a strong 36.3. The bulls have reversed to become in charge. The risk index is the 30-period moving average of the VIX divided by the 10-period. The 1.0 is the boundary between risk on and risk off, so we are still in risk off conditions with the reading at 0.904. We take that score and look at the last 5,000 trading days, and we compute the risk Z, which is how many standard deviations above or below the long-term average that current reading is. It currently reads minus 1.15. You can see the 90-day histogram of that indicator. This was that long kind of grinding bull from the beginning of the year, and then the harsh sell-off, and then this rocket-like recovery. We are into the spring of swing trading here with some nice gains as the indicator races back towards the zero line. When it crosses, this becomes summer, and swing trading is in full bloom. These are the current holdings for blended monthly rebalancing. Next rebalancing due on or about 1 March. These have been performing very well in this relative rebound. These are the winning positions based on Friday's close and performance. ETF2 theoretical exposures back to 100%. This is a sample of one of the advanced swing course students who's been trading along with our instructions since the beginning of the year. And he has made 58 trades. These are the individual R multiple returns. 41 winners, 13 losers, 4 scratches. So that's a 71% win rate, 22% loss rate. The average R winner has been 2.3. The average R loser has been minus 0.67. That leaves him a system quality number of 4.58. If you normalize that over 100 trades, that would be a system quality number of 6. You can see the rolling average R here. This is the cumulative R. This is the histogram of returns. It has all the things that I look for. First, tightly controlled risk capped at -1. A positive average between -1 and +2. A normalish looking distribution between -1 and +2. And then the possibility for fat right tails. Here you see the sequence of the trades through time. So all systems go. We'll be applying the trade index analysis to this to see what might have been reasonably available in the near term, so we can try to optimize this performance a little more. But so far, so good. The 13 ETF portfolio and 32 for BMR, Latin American technologies, and Brazil have returned back to the top, leading the way. So leaders going to lead, laggards going to lag, treasuries and real estate. Performance of the Dow 30 through the same lens. Leading candidates here: Boeing, Cisco, Cat, Morgan, and Microsoft. Laggards: GE, Procter & Gamble, Merck, Coke, Johnson & Johnson for those searching for quality on sale. GE remains a very intriguing situation, as does McDonald's, which had been lagging but now is beginning to lead. So there may be a turnaround play in McDonald's that we will frame. And I like Caterpillar based on the momentum that I see here, and Intel. Looking for continuations of those momentum plays. Walmart, this can't possibly be anything but good news for deep value players. Want to buy the best company in America on 11% sale? I'm interested. Let me see. Sector spiders. These are all 31 different subcomponents of the S&P. And you can see that metals and mining and biotech had been leading the way, suffered a little bit this week. There was some buying in technology, oil and gas, and equipment and exploration, along with semis. So technology looks to be interesting. That means tech. XLK should be on our list as a continuation pattern. In ETF Max, return of energy to the top. Oil, small cap healthcare, metals and mining. So that would bring us to these two, basic materials and energy. Market health check. See the big sell-off. Nice rebound. The baby dragon has crossed the dragon. Price stayed on the north after this little pull-off and started to resume while staying on the north side of that of the dragon. That is very favorable, and that suggests a return to 284 is reasonable. And we're back under a 5% sell-off from the swing high. We moved from oversold to overbought. The slope of the 30 has started to at least get to the 6 o'clock position, is starting to improve. The 10-period regression channel is up. The steepness of the 30 has, like I said, started to slow down. The MACD histogram, this was that nice rebound in here. The pause that refreshes and beginning to resume. And so with the ball, now we're above the zero line, so we have a long side bias. And the bulls are starting to return to power in the ADX. And this looks favorable going into the week ahead. In the regional report, everything's back above its 4-month moving average. Inside, well, let's see, in the S&P at 59 is better than the globals at 45. So it's still the U.S. over the globals. And then inside the U.S. it is technology, then large caps, and a tie for mids and smalls. Latin America and U.S. tech are the two strongest candidates. Asia less Japan and European 350 are the two weakest. Strength in financials, industrials, and discretionary. U.S. showing real strength here. Brazil and Latin America also where it's at, along with these large caps. Stay there. Oil and energy still good. Mixed bag in Asia. Generally weakness across the board in Europe. ETF top 30, no surprises here. I like to look for green and then white. So that would get us to Latin America, biotech, the Qs, industrials, and information technology. So that's consistent with what we're seeing across the board. Meanwhile, DIA remains very strong. Greens across the board. Shift into the daily. No signals on channeling and overreaction. Walmart, Max Payne, GE, Max Payne, Merck, and Coke. I think it's time to be looking at those. I think they're going to benefit from rebounds across the broad sectors as fear resides, or subsides, I should say. Devon Energy, I like that. My old buddy. Channeling here in Walmart. That was the big red. And GE getting smashed. Walmart 6.2 to 1 on the auto framer. Let's just stop and take a look at that one right now. Love it. All right, so here's GE. Let's take a quick look, just a quick frame for those of you at home. That little doji at the end, so the big sell. We got our second short in here, and our stop is here, so I'm going to lock that in. Right here you can see prices coming back towards the flip of the PSAR getting ready to flip. We are still below the zero line in MACD histogram, but the signal line has crossed over, has come back into that red river and is tracking up. So this is failure to fail further. So I'm prepared now to get long above the PSAR flip at around 15, and I'll get short again at 1440. That's my trade frame. Let's add this right here. And I'm prepared to go in either direction. On the upside, I think the RL270 and the Bollinger Band mean is plenty of upside. Downside would be an extension, same distance, that far. So that's our trade frame for Walmart, and we'll play it that way. I would actually like to get long right in here. So I'm going to put a second entry in there. So if it starts making this move, building a base, then I'm going to get two positions in here. And I'll add a third one there. All right, so that's a quick look at how we would frame Walmart on that basis of the max pain. Okay, moving on. On the strength side, Intel, Microsoft, and Cisco, that's tech across the board. I wonder what tech would look like on that trade frame, you ask. There's technology. We're already long 1, long 2, and our stop was here, so we're going to tighten that up. And then if we get above this RL10, that's where we would add a third position. So that's where we're going. It's just above 69. Okay. And then Intel. Love it. We're already long 1. Should have had a second one in here, darn it. So we'll just tighten that stop up. This is where we'd been short. So if it breaks above that level, then I feel really good. That's where we'll add a second position in Intel. Up in here. Microsoft. We're long 1, long 2. Our stop is here. We'll tighten that up to here. Again, I'll add a third position in Microsoft above that RL10. Looking right here. So we're in good shape on that tech rebound. This is the advantage of the core and turbo approach. You know, we have the weekly reviews, which leads to improvements on daily, using end-of-day trades, and then we use those for guidance to our intraday trades. So when you see these enormous range days in here, we're really piling on intraday when we have something that's going to move on a swing trade and then gives us a strong intraday move. That's core and turbo on the short side, on the short time frame of swing trading, and then this weekly, daily review helps us on the slower swing trading as well. So tech looks pretty good. This whole business across the board. You can make a living on that, by the way. ETF 30, not much to choose from here. The VIX has been giving up a lot of those gains that it made on the big sell-off, so much more back to normal. XLP, the consumer staples, still is 2 to 1. That looks favorable. Pinch and stretch. Cisco is now stretching to the upside. That's That's a really nice one. And we're long from here. One. Oh, and covered. Sold off. And now we are ready to go 1, 2, 3. We're going to reward that. So I'm going to set that trade frame in place. And just bring this one forward since we already have it built. That's what that trade frame looks like. If it fails below here, then my targets are going to be back to Bollinger Band mean. And then I think this where we got long before right here. So that's the downside. And the upside, it'll get above that RL10, and then off it'll go, and we'll just tag along and trail that stop. So Cisco in pretty good shape. Negative pinches, Walmart. We've seen that one already. Devon and Coke. We'll frame those in the usual way. The most expanded pinch boxes are the ones that have had the longest consistent directional 30-day move. It can be in either direction, but it just means that's the most consistent and strong directional move. Only gold is on the super pinch because of that wild volatility. It'll be a while yet before we see those. But these are the ones where the width of the river is really starting to get narrow. So I like that in Brazil because that has been one of our nice intraday and swing trades. You can see this getting just a little bit tighter, not super pinched like it was down here and where we exploited that move here. But the expansion of the Bollinger Bands, the width of the river is narrowing nicely. That's starting to get pinched a little bit. But I like that we're in 1, 2, and this was our exit up in here. I like that we cleared this price target. So we're going to have to push our stop up at least to that. And I think I want to add a third position in Brazil if it gets above this RL10. So what I'm just showing you here is the same approach that our student used, generally speaking, to achieve these kinds of results. Systematic, day after day, just do your homework. And you can use end-of-day data for that. All right, back on board. That's pinch and stretch. No auto framers to show per se. Regression line fractal framework. In the green, the ones on the top shelf are the ones that are most numbers of average true range below their long-term fair value. So these are now becoming deeply discounted value plays. These in the red are how many ATRs they are above their fair value. That's why I show them as overheated. So Cisco is 3.5 ATR above its fair value. So I'm more I like being on board these. We've seen us with those positions on, but I'm respecting those stops because I think the money's been made. These are the ones on the deep discount side that I feel safer when we get our trade entry after our frames. And then this is the Dow 30 stack, the ETF 100, and the S&P 100 stack. No squeezes. 30-day regression line is the blue one. This is the polynomial. It gives us a directional heads up of changes in the direction of the slope, so it's improving. And this was really a strong statement on Friday, this gain. And you can see that it's getting ready to cross over its own 10-period moving average, more than almost 3 standard deviations away from the long-term average. So that's going to be like the official turning point back onto the long side. But we're already well into that first phase of recovery, which we've been careful to exploit. The usual. You see, yeah, the 10 is already recovered. The 30s come back to the 6 o'clock position, if you will. The overheating in the 90 has cooled off. So I think we're ready for another retest all the way up here to 285 at some point. Does it get there in a straight line? I doubt it. But certainly the upside grind, much like this, where it comes out of the river in steps and resumes the grind, I think that would not be surprising. And that's everything I want to cover. We're 20 minutes into it. Thanks for your kind attention. Still plenty of time to get with us on the advanced swing course. We're actually going to start a new course based on some popular demand around the 1st of March. So if you're interested in some live portfolio management and collaborative learning with accountability partners before the price on the course goes up, please get a hold of me before 1 March, and we'd be happy to add you to the list. Take good care. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.